Everybody, good morning. I have the pleasure of introducing Andrew today. Andrew, he's the CEO and co-founder of Doorvest. What's up, buddy?
What's up, man? Thanks for having me. This is a fun way for us to hang out.
Connecting with friends, smiling, sharing life lessons. I always enjoy. It's one of my favorite parts of doing this, right? Just experience sharing and showing the real war story that got us here.
I'm envious of actually having a position and sort of a reason to just hit up friends and hear all of the stories that you're obviously not going to hear about in the day-to-day.
Let's go into you personally, so we kind of get to meet you a little bit better. So you were born, and then what happened? How did you get to be the CEO of Doorvest?
I was just born and then I just became the CEO. Yeah, no, just kidding. So grew up, was born in San Jose in the Bay Area, sort of like during .com. Grew up with immigrant parents that were so far removed from tech and .com. So never saw much of that, though it was happening all around me. Fast forward some years, ended up sort of in startup land. So stumbled my way into various startups, mainly because I was awful at school and no one else would hire me. And so these random startups were the only people that would hire me. And then sort of nights and weekends, I was grinding away at a job. I had a really good job, was paid pretty well for like a young kid, had some savings, started thinking about investing in passive income and cash flow, etc. Obviously, all the keywords that spit out real estate investing. So stumbled into my first investment home in 2014 in Sacramento, California. Bought my first one then, got obsessed, did a bunch of crazy financing, etc. Eventually scaled it out to a little bit over 10 within a couple of years. And then just like friends and coworkers kept asking me for the playbook on how to get started. And I was like, yes, of course. Like, here's how you find an agent. Here's how you analyze a home. Here's how you write offers, offer sticks, and figure out how to get a mortgage, insurance, title. Then you close on it. Then you got to renovate it, lease, manage, bookkeeping, and taxes. And by the way, you should buy a couple of homes to build out a portfolio because you want to diversify versus just having one. Sent them off on their way. Naive as I am, didn't hear anything for months. Then I'd bump into them like 4 months later. I was like, how'd you do? And every single person was like, could not get started. I actually have more cash now because I've been saving. I've been sitting on this. Like, can you do this for me? So eventually that became the genesis of Doorvest. It's kind of this online end-to-end experience for people to buy, own, and sell investment.
So before you started scaling, before we get into the business side, what do you do for fun? Like, what do you do on the West Coast?
Yeah. Funny. I used to think about passive income and retiring on a beach, etc. Nowadays, I just work my butt off most days. Before we talked, we were talking about venture capital and growing really quickly and stuff. And it was like quite the opposite of retiring on a beach, unfortunately. But outside of it, play competitive tennis. So I grew up playing tennis, got pretty decent. Didn't get to play D1, kind of always wished that I was able to, but never quite got there. Sort of reliving my tennis dreams on the weekends.
And my joke is, I do anything where my phone has no reception. So if I could be playing sports, scuba diving, anything that's outdoors and adrenaline and I'm sweating and I get to reload, it's my jam. I work all the time. I have a home gym. Like, to me, it's more about blasting loud music and not reading my emails, because once I do, I'm hooked.
Yeah, man. I think it's so important, right? Like, and I think that's part of that amongst many other things is what I get from tennis too. It's just like, there's literally no way for me to pick up my phone and read an email or send a Slack or text you back or something. I'm just like so focused on this one task at hand, which is it's beautiful. Yeah, just the ball. Yeah, I'm like, this,
Love it. Thanks for being human and connecting with us. So on the Doorvest side. So walk us a little bit higher on the business. Who's your core customer? What challenges? What is the dream? Walk us through, so people learn about the platform.
Yeah. So from a platform standpoint, we believe that the vast majority of American wealth has been achieved through homeownership and real estate ownership. And as we know, a vast majority of Americans, and increasing, just given where the environment is at today, aren't able to access real estate ownership with interest rates where they are, homes scaling far quick, or home values growing far quicker than wages, etc. We're building a platform that makes it easy for folks to first buy their first ever investment property. So right now, 50% of our customers are first-time homeowners, meaning they're renting wherever they live and they're buying an investment property with us. We'll then do the management of it. And then about 30% have purchased a second property with us. So we hope to financial services platform that is anchored around the concept of investment property ownership.
And where are the users coming from? Where are the buyers coming from? In the US, international, where are they coming from?
30 different states is sort of the headline. So kind of all throughout, from a real estate standpoint. Of course, we're like focused in specific geographies that we think good rental yields and have good upside appreciation over time. But the demand side, as we call it, is sort of all throughout, and then some international. I think the international part is it's an interesting market for us to spend time on one of these days. The concept is the same. You could buy investment properties and manage your portfolio from anywhere. I haven't quite gotten to full international expansion stuff yet.
And what challenges are you seeing today? Like the markets have changed a lot recently. Let's not go into the market tip, but just as a platform, as a growth, the things that, that are hard right now.
To start with something that I think was more straightforward than I had expected going into it was I underestimated how much Americans believed in real estate ownership as a vehicle for building wealth. I actually thought, maybe I'm the crazy one, but I actually thought we would have to spend more time educating people on why and like the numbers and the math behind like why real estate ownership is so powerful. That part was actually quite straightforward. I think the part that has been arguably the most challenging is the complexity of the business, right? So we're doing basically everything. And so in any given day, it's like, where the hell do we focus the energy, our limited resources, the team, etc.? We're buying homes with our own money. We're renovating homes. GCs, as you know, are very difficult to manage and it takes a lot of time and there's always delays and overages, etc. And then we're selling the home. Then we're doing the property management, as we were just talking about before. And property management in and of itself, it's quite painful. And then we try to do it over and over again. So I think if I were to sum it up, it's just like so many different moving pieces. It's super complex. Where do we spend our energy and resources?
I think people don't realize how many little steps are inside a real estate transaction and how much red tape there is. There's a lot of transactions that happen every year, every day, literally, but there's so many little things that gotta go right and could go wrong to screw up the closing transaction, right?
You probably experience the same thing too. It's like, even in the closing process, it sounds like it's just one thing, but you're like coordinating a buyer and a seller, you're coordinating a mortgage lender, and then behind the scenes, there's like an underwriter that's doing the mortgage, and there's like the title company, and like there's all these different parties that have to line up for one to just close on a home. So yeah, I totally feel you on that. And that's kind of the world that we live in.
And it's a physical asset, which no matter what we design and engineer and do product with, there's still a physical hard asset that, the pool might be green. There might be a hole in the wall. There might be something that you cannot expect that is not on Zillow, right? So like, there's always those curveballs of, okay, now let's see the physical asset and what's really there.
Right. Yeah, like truthfully, like on my worst days, I'm like, man, enterprise software, it's a very straightforward thing. You find a customer, you build a thing, they buy it, and then you do that again. And if you don't have enough features, maybe you spin up a couple more features, that's like on my worst days, I think about that. On my best days, it's like, yeah, it is a very physical thing. It's a very meaningful transaction that we're creating value and hoping to generate some value for ourselves too. Have you thought about doing stuff real estate?
I'm an investor in a lot of startups. I love startup crazy. And to me, my favorite meme is that dog drinking coffee and there's fire everywhere. Like, this is fine. Like, I don't know. I'm broken that way. Like, I got my behind kick starting when I was 21 and like, I'm unhireable at this point, which is crazy. But like, I enjoy staying up late and designing stuff and breaking things and restarting it and testing things and having the aha moment. But there's a lot of dark nights to that where things don't work. And like, everything is not up and to the right. Like, I have a friend of mine who has a saying, a joke that he has it's the 10-year overnight success. Like, everybody sees the end, but no one saw the disgustingness before that for a decade of getting your ass kicked and learning. So yeah, I think, I love connecting entrepreneurs and getting other people to like see what's behind the veil, because there's a lot of sleepless nights in there. Question, so the world knows, so what markets are you guys in right now? Because, this is very physical, very local. Yep. What markets are you guys at right now and where do you want to be?
Houston, Dallas, San Antonio, Atlanta, Oklahoma City, the 3 Ohio markets, so Cleveland, Cincy, and Columbus. And then we've done a little bit of work in the Panhandle in Florida too. We're sort of kind of all throughout. We're pretty concentrated, at least new transactions in Ohio right now. That's just a market that ourselves and the investors on the platform are pretty excited about. But like historically, a lot of our portfolio is in Texas. We're not doing a lot of new transactions in Texas, but historically, a lot of portfolios is in Texas.
Let's talk about the entrepreneur journey. So if you were to hit the time machine and go back, what do you do different when you start building the company from scratch? And what would you do different with the learning experience?
I mean, truthfully, so many things. And this is why I'm not. Like, as a young kid starting Doorvest, I was sort of like knuckleheaded and was like, why do like second time entrepreneurs always like have it so easy? Like it's sort of unfair. And I'm like, oh my gosh, I totally get why. And they totally deserve it too. I'll give you two. I think sort of an operational standpoint, we had insane customer demand in 2020 and obviously 21 and going into 22. Like there were so many stories where we'd find a home, we'd send out someone to walk it, they'd build a scope, we'd throw it up on the marketplace. Within 2 hours, someone would buy the home. 3 people would write in pissed. And they were like, I thought your mission was to help me get into real estate. I have a day job. Like, how the hell am I going to get started? And so that was great. And so that led us to sort of this pursuit of like growth and a lot of growth. 21, we grew a little bit over 10x year over year. And so you think about our very physical businesses, like everything breaks behind the scenes. And then it's extra painful when you realize that growth goes away when the market suddenly changes. I think operationally in hindsight, like I think we should have been disciplined and throttle some of that growth. Like even though there's people that are lined up out the door to buy more homes, like maybe we should not have accepted as many as we did at that given time. That's not to say don't grow, but maybe 10x was a bit too much. It's probably one that I'd say. I think from a team standpoint, like a concept that really resonates with me now is sort of the concept of demanding and supportive. Intuitively, humans think these two concepts are at odds with each other, where it's like either you're an asshole and you're very demanding, or you're supportive and you're coddling. I think that there's a way to sort of overlay the two, where you're demanding because you expect and you believe that the individual is able and capable of a lot, but you're also supportive when you're pushing them and they happen to trip or something, a road bump. It took me a little bit too long to lean into the demanding piece, and I think it led to all of these unintended consequences.
Life lessons, those are the valuable ones. So let's go into the real estate talk now. The world's crazy right now, right? There's doubt everywhere, and tariffs and interest rates and vacancies and HUD problems and foreclosures. I kind of love that. As in, I'm running towards the fire, and my first business is that world, and I see lots of opportunities. But before we get into like what excites you, like what scares you? Like what where are you seeing like where people are, where there might be more pain or what? Because you're in different markets. What do you see? What scares you in the real estate world?
Business doesn't like volatility. I think in an up market, in a down market, doesn't really matter. I mean, it does matter. Obviously, we all prefer an up market, but at the same time, like an up or a down market doesn't really matter as long as it's predictable, right? Like as business people, you're making decisions based on some assumptions. And if the market is super volatile, you can't make any assumptions. And so you put your pencils down and you try to wait it out. As a consumer, that's very much the case too, right? Like if you think you're going to get laid off, you're not laid off yet, but maybe there's a chance you're going to get laid off, or you think inflation's going to run away and you can't afford to pay your rent or your mortgage, etc. Like you're not going to make a big decision until you see how things play out. And so I think just like the volatility, regardless of what happens, just like the present volatility, it's just a very tricky environment to navigate. And I think some of it really is just like, how do you just hold steady? Because I think we all agree at some point, the volatility subsides. It's just what?
My experience tells me to run towards the problem now, right? When there's opportunities, when a couple years ago, everybody was buying cash sight unseen. I saw it on Zillow, buy. When now people are terrified, like price points get more realistic and rents not completely fall off the face of the earth. Like I think there's way more, personally, I think there's more actual opportunities happening now than, I know interest rates are a lot cheaper, so you can borrow, you can pay more because you're borrowing for less. But as to make your money in the acquisition, I think there's more opportunities now.
Yeah, I mean, it goes back to like the old Buffett adage of like, exactly. Much easier said than done, by the way. And I see it all around us too. It's like a lot of people believe that conceptually, but when your heart doesn't feel it, it's really tough to say, hey, everyone's freaked out, but you know what? Now's the time to do it. And so we'll see what happens in hindsight. Similar to you, like I actually think there's a really strong case for whenever the market subsides. I think the administration is very focused on driving down interest rates, mainly for the federal government, but they also have this big sort of like Main Street agenda. And I think that will give our market like strong tailwinds whenever that comes. Who knows? We'll see if I'm right in hindsight. But if I am right, then now would have been a really great time for folks to buy.
I agree with you. So that's on the what scares us world. What excites you? I told you what excites me. What excites you? Where do you see opportunities?
I very much believe that our platform is a way for people to build durable generational wealth, and it just takes time to compound. I think from a pure platform standpoint, seeing us grow our repeat rate from under 20% to over 30% in a handful of years is really encouraging. It proves to me that what we're doing by helping folks buy their first investment property and then build out a portfolio is working. And if we roll that forward, I can imagine that as people make progress in their careers and earn more money and save more, etc., will generate more business while they also accrue more and more returns. So I think that part really excites me. Not to use something that's very in the headlines and just very popular in consensus nowadays, but like I do think the AI stuff is really fascinating. A question that I talk with my friends often is like, what do we think will change and what do we think will not change in a world of AI? There's many things that will change. Like I'm sure you're playing around with it so much. It's like you could have AI write all of the code for you, and kind of what does that mean when you don't really have to be like, what does that mean from a labor standpoint, and like what are we all capable of doing with AI ourselves? And you watch the sort of acceleration of it all within the last 6 to 12 months, and I think that part is pretty obvious. I think a lot of people see that. I also think back to our earlier point about real estate being very physical. Like, I don't think AI is going to change that. And I think if anything, it sort of increases the value of the work that both of us are doing.
I concur. How about on the like finding transactions? You know, the world's a lot more digital now. It's a lot more, it's not local anymore. You're able to find properties on your phone at 3 a.m. scrolling through whatever. There's a lot more platforms. What do are you guys running the opposite away from that, meaning more the local market and kind of meeting the experts in the region? How are you guys finding deals?
Yeah, that's a really interesting question, because I think we flip-flop back and forth all the time. Like at the end of the day, when you're buying a home, as you know, it's like you're buying from a human, and humans want to do business with other humans and people that they trust. And Alex, because I've seen him 4 times now, and like I just like the guy and I trust him, and so there's a part of that that's uniquely human. And so I think that's where having a local presence is really important. At the same time, I think you can get to like 90% of everything without being super local and like super on the ground. We still do a lot of work through wholesalers in various markets. So we're one of the few institutions that's like consistently buying and also aggressively scaling. And I think we found a nice pocket, which is like we like to do the renovations work. Like that's become something that at first was just a pain in the butt, and we had to do it because we couldn't buy like ready to go MLS. Exactly. That's been sort of the focus for us.
So take us to that. You were doing more heavy lifting properties, right? In many different places. Give us a war story of how it went wrong and how it went right, or how it went right, because people think this digital, you buy it, real estate is passive and nothing ever happens, when in reality things happen, things break. Any war stories that we can laugh at post the fact?
I think on one end we've delivered on this experience where our customers can get matched with homes on the platform. I think you've probably been there, maybe not, but get matched with homes on the platform, compare and run through the financials, and ultimately click out within a cart, sort of this e-commerce like experience. Very proud of that. On the other end, like someone has to do all this heavy lifting, and that's us. I could tell you stories of where like renovations budgets just go on and on and on. I could tell you stories of where, and I'm sure you've experienced all of this too, it's like general contractors like take your money, buy supplies, and then go away. Or maybe this one is a little bit less funny and more frustrating, but there's just so much fraud too, like from like renters that are looking to go after homes that look like they're managed by like a large nameless, faceless institution, and so there's just like all of these like fake identities that end up like trying to rent homes, and then once they get in, they never pay a dollar, and then eventually they just leave and hand the keys back. Man, it's just the world of atoms.
Yeah, well, it's also the things that no one tells you, right? You rent a property, it goes up, you don't have to evict anybody, vacancies never had there. It's great. And then you're like, all right, there's some real pains and things you gotta learn from.
Yeah, that's the part where I feel like, I think as an everyday retail investor, sometimes you just can't take the fact, like just psychologically, like if someone breaks into your home, you feel a certain way about it. And if you just hang on to that home for 10, 20 years, like the break-in doesn't really matter. The vacancy for a couple months, it's annoying. I wish we had more rent, but at the end of the day, it doesn't really matter. And so how do we bridge that? Sort of the next frontier that I want to spend our time and energy trying to solve for. Like, how do we minimize some of that volatility?
I think of it long-term leases, honestly.
Yeah.
And that means in commercial real estate where you have a triple net lease and it's 5 years, taking less upfront and saying, I have more peace of mind. That's going to be there longer, right? That's why I generate, when we were designing self-plan, that's one of the main things we put into from life lessons of, in the long term, you're going to be perfectly fine. But in the short term, if you don't have a portfolio of one property has debt service and you can't really fund the gap, then you get into trouble. So like my previous world, we used to cross-collateralize lots of assets so that we create a portfolio. In this world with self-rent, we are literally engineering longer term leases because as an owner, like when you buy real estate, you want the tenant to be there for a long time and not bother you. To be blunt, right?
Yeah, totally.
Totally. You do your own stuff, you're paying on time, whatever. So I think of it as like, instead of getting the extra $50 or $100 or $200, can I get a 3-year lease or something like that gives me peace of mind, and I'll worry about it down the line. I'm getting $300 less, maybe there's $3,600 a year, but like, what if I don't have vacancy at all, right? What if I can predict the cash flow easier? So
totally. Yeah, and actually, that it's the same for the resident too, right? Like, if you could take a little bit less, you don't have to be at market rate. And like, I think then there's also like a human touch to it. Like, I think the resident is more incentivized to just stick around longer. And I think that's sort of a win for everyone too. So some of my best personal investment properties are like ones where, I don't know, we're like 10% below market, 20% below market rate after like 6 years. And it's fine because it's the same person for 6 years.
Yes. I have lots of tricks in that one. On the tools and tricks, we're talking AI, we're talking technology, anything that you wish you would have had earlier you're like, oh my God, this is insane. It's saving my life. Anything people could learn from as to like your tricks?
I think it's actually just the psychological piece, which is just like focus on the long term and sort of almost lose sight of some of the day-to-day volatility in the stuff, because I think that's the best way to stay sane when, and I'm talking about like from building a business to my personal investing to all of that stuff too. But if people are looking to invest in real estate, I think it's important to remember like this is a long game. Like we're looking for the equity growth over a 10-year time horizon rather than, I don't know, a couple $100 in the short term, and stay focused on that piece. And if that's the case, and if you're looking at your investment through that lens, I think you're just that much better equipped for the day-to-day volatility that will inevitably happen.
With it. I like it. How about on the myths, like especially in operating, growing a company, managing it? What's the myth that you're like, that drives you nuts, that the first time home buyer doesn't know, that they're like, you should be like, just be ready for this, right? Like what myth drives you nuts in this industry? I can give you one what you're thinking, which to me is real estate's passive. And I'm like, from my humble experience, no, it's not. Like, you gotta be dirty a little bit, right? I think with the world of fractionalization and LP investment and all that, you're able to be a lot more passive because you're investing with an operator or someone who's doing a lot of the work. But if you're doing something yourself, for the most part, it's not going to be that passive, right? Like to me, I don't even have two left hands. I have no hands. I'm worthless when it comes to fixing stuff, right? I can't ever take on a big project that I got to do myself because it just goes to zero, right? So like, I know if I'm doing something like that, I need to have the right budget, the right team, the right operator, the right construction person, because but I know that I get in front of it, right?
Yeah. And by the way, I totally agree with all of that. Like it's physical. There's a lot of different things that happen along the way. And I think back to my previous thought, which is like to tie the two in, like I think can be very lucrative if you could hang on for a very long time. But in order to hang on, you got to be able to get through like the volatility, which is, I think, the opposite of passivity. I think there's something that you could design and build there, but for another day. Yeah, I think from my standpoint, and this is something I experienced firsthand too, it's like this quest, this elusive quest for more cash flow or more yield. I think there's a generation of folks that grew up learning about real estate, and I group myself into that bucket too. And there's sort of this sell of like, there's so much cash flow and therefore there's so much passive income. But I think in order for you to get something that pencils on paper with a lot of cash flow, it's probably not a home that you want. And maybe you do want it, but it like just be very clear-eyed that this is not a home that you want for the long term because of all these issues that you run into later. And so I get it, right? Like people, the numbers look good on paper, and so people are drawn to it. At the same time, it comes with a steep cost, which is like not passive. You get break-ins, you get all this crap that happens, and then eventually, I think you're going to ditch the home, and because you ditch the home, you're not going to be able to capture the long-term upside. And I speak that from personal experience because I mean, my first batch of homes were all the cheapest 3 bedrooms in the city at the time, and like you know exactly what happens. Like I got the keys back from a resident, I drive to the house, there's a squatter cooking at the kitchen that's pissed at me because I walked into my house. It's just like that stuff happens, you know.
I have the exact same experience on the commercial side, multifamily, where we're young kids and all we could afford was Class D and C real estate in the hood, and we buy it and on paper is great, and then you're like, you have no idea your R&M is 70% of your budget, and you have crazy evictions and copper wire disappears, and you have all this crazy stuff. So all the older guys are always going for like B and A type of things for and less return, and we were going for the double-digit gross cap rate and NOI growth and all that, and then we got So feeling on that one completely.
Would you do it again in hindsight? Do you think you would have done that in hindsight, or like was it because you just didn't have the capital to go up? Or
1,000%. So when I was
you had to, right?
When I was 23, there was no buying something more expensive. It was we raised 100% investor money. It wasn't even our own funds. It wasn't like I had the option. It was also 2010, and there was not a lot of debt. So it wasn't like you go with a DSCR loan or crazy LTV loan. Would I do it again? I think I learned exponentially more than I would have done by starting at a big firm and buying something wearing a tie and sitting behind a computer. I think getting my hands dirty was priceless, and my on-ramp was extremely fast, right? Just because craziness is happening and we have to survive. So I definitely, but now getting into my 40s, it would definitely be more a nicer asset, less return, actual, forecasting things that are going to hit, and just learning from the last decade of doing the craziness. What do you think the biggest mistake new investors make? Like, and what can they do to avoid it?
Actually, it's interesting. It goes to the same topic too, which is like, obviously, I think number one is like, I wouldn't overthink things. Like if you're excited about it, find something that is bite-sized, something that you could chew, and then do it, and then you will learn from it. You will learn from that experience. And obviously, I wouldn't do something super adventurous, be like a total tear down on my first deal. But if you're excited about it, like find something that, I don't know, is turnkey, close to turnkey. It's a price point that you feel okay about. There's not like a bunch of crazy unknowns to it, and then just do it and know that you're learning a lot along the way. I think that's probably number one. The close second is kind of to the point of what we were talking about earlier. Is like, if I could go back, I would have bought homes that were 10% more, 10-ish, 20%. It's probably about 10% more than like the batch of homes that I first bought. And so it was sort of a step up in neighborhood. And had I bought those, I think I would still be holding on to those homes today and have them ride. Whereas at some point, I just got sick of all the break-ins, all the turnover, all of like all of that stuff. And I think it was all driven by like cash flow.
Yes, and yes. So kind of looking at the US as the market, any cities that you're not in that excite you, that you're like, something's happening there, or anything people should be like, not to compete against you, but just like looking at it from a different perspective? At the risk of
sounding like I'm talking my book, I am really excited about Ohio in general. I actually personally haven't been able to purchase for myself in Ohio, just don't have liquidity as it stands. But Ohio has already been this growing market for years now. I think there's some good macro tailwind in Ohio as well too, and just some optimism in the market. And so I do think the Ohio markets are really attractive. I think another one that's sort of looking at from the peripherals is some of these markets that got really inflated over COVID. And I've also seen like a resulting major drawdown, like the Austins and the Phoenixes of the world. I don't think we're quite there. at some point they become attractive. The markets are still fundamentally really strong as probably they ever were. It's just that the prices got well ahead of where I think the market should have been. So that's kind of what I've been sort of like lightly looking at. But what do you think?
Yeah, I think there's a giant gap, at least for the rental market. Like, let me try that again. For the investment market, for a rental product, I think like Phoenix, prices took off, rents didn't follow. Big gap. Austin, great city, love being there. Lots of inventory, crazy vacancy now, right? So it'll catch up. But we think happening in Des Moines, Iowa, like that sort of thing. I see opportunities. The west coast of Florida, the exact same thing. Lots of people move here about house sight unseen, all that type of stuff. I definitely see opportunities there. We also, as a company for Seltzer, we love Ohio, Kentucky, Indiana, because the finance works, the math works, right?
Yeah, totally. Yeah.
$250,000 home rents are $2,000, $1,800, right? So it's not a giant gap. And people in those areas tend to take care of them. You're able to have long-term tenants. Like the homes weren't built in 1912, right? Yeah, I like the middle United States. And I also agree there's a giant gap when it comes to those markets that grew really, really fast. And now they're coming down a little bit.
Totally. Two very different markets, right? Like they're sort of like these consistent, reliable markets that have seen sort of steady growth and they didn't whiplash up or down. And just to your point, have good families in like decent sized metros with decent jobs. And so that's kind of where we're primarily focused. And then there's sort of like perhaps at some point in Austin or Phoenix there's some value once the prices come back to it.
Not for sure you're going to hit me with San Francisco office.
Oh, yeah. San Francisco.
Oh, man. Hit me with it.
Look, I do think we've bottomed, by the way. I do think we've bottomed. I mean, on that topic, like the energy of the city is much like it's growing consistently. I think the new mayor is doing a good job. I think the city has at least realized the downside of some of the stuff that we had encountered before. Whether or not we get back to like 2019 peak, I don't know. That's a long way from here, but I do very much believe we've bottomed. Yeah, we could leave this into the recording and let's fast forward 10 years and see if I was right there.
It's a friendly conversation, not a prediction model. I got a question for you to close out before that. Anything you want to ask me? Anything you want to learn?
What are you excited about going into, I guess we're 1/4 of the way through, but in 2025, what are you most excited about? Can be within the company or outside of the company.
I'll give you one in, one out. So as a team, we're super excited building the platform with the crazy technology that's out there right now. I think it's a mental shift more than a technology shift. Like to me, AI is a race to zero, and it's can we use all these awesome tools that are going to get more and more awesome tomorrow and the next day and the next day. And within our team, like we're talking before this, it was crazy. If you don't have the mindset as an employee, as a team member, as an owner, a growth mindset, you're going to see AI as a very scary thing, right?
Totally.
So we've for the last couple of years, we've been like, let's go break shit. Like, let's go test and try and see. And if it doesn't work, cool, we cancel the membership, right? So at no point do I want to build a crazy AI company, but we're going to be powered by AI everywhere. We already do it with marketing, we do it in code development, we do it with sales, with transactions, with investors. We're already putting it everywhere, and we failed and we won and we failed and we tried and we succeeded and whatever. But that's within the company. It's like if you are not using AI, kind of like the Shopify model that they have now, like it's not replacing you. We want to give you superpowers. Because to us, what do I care about paying $40 for a license when it makes our employees and our team members so much better? So that's inside the company. Outside of the company, look, our big BHAG or big hairy audacious goal is to help a lot of people in distress, homeowners. And I see a lot of distress coming, and it's already here. So when you talk about credit card debt and foreclosures and divorces, and like a lot of people see this as doom and gloom, I see it as a giant opportunity to help people. And I think we can help a lot of people. And like, no matter what anybody tells me, I don't think divorces are slowing down anytime soon, right? It's just part of the world today. I don't think foreclosures are slowing down. I don't think credit card debt is slowing down. So we're seeing lots of people from across the US come to us in those segments who have a lot of home equity, who have great assets. They're just in a situation where they need a financial reset. Well, we'll help them. Like that's where what excites me from inside our world, right? So we're not chasing unicorns, right? We want to be real, helping people in real trouble. And we believe investors should capitalize on that because they're finding off-market inventory and also great assets. Now you have a tenant or a seller that's becoming a tenant that is liquid now. So they prepay rent, right? Maybe they pay an entire year up front. Maybe they stay for a long time. That's where we're excited about putting those two things together.
It's such a compelling and exciting mission that you guys have. Like, to your point, like people always have these life events and sort of end up in tough spots. At the end of the day, they also have a great asset on their hands with lots of equity. And so like, how do you facilitate something that solves their challenges there? And then very much so, like, I very strongly believe that, unfortunately, like a lot of Americans Americans are just in a tough spot. Like years inflation that are squeezing them, stagnant wage growth, and everything not being affordable. Well, too, like it feels like the business is sort of like right and primed for the environment that we're going through.
Let's do it. Okay, let's close this out. So on a friendly thing, you go back in time, you work your tech job again, you put together $50,000, and now you're like, you know what? I want to get into real estate without using Doorvest. All right, well, you can say Doorvest if you want. Like you are a teacher, you're a regular employee, and you work your ass off, and now you put $50,000 aside. What do you do? Like, how would you start your real estate journey again if you were in that situation?
I mean, it's pretty similar to my initial purchase too. I would say find a market that you're excited about for some reason. Like trust your intuition there. Excited about Miami because you like to hang there and like the energy is good when you get there and it feels different from the other place you traveled. Maybe if you're excited about, I don't know, like Columbus, Ohio, because you see a bunch of your friends working for companies that are there and they're propping up new companies, etc. Find a market from a market level. Find a market that you're excited about. I don't think you could really go wrong, right? Like if it's a large market and it's shown some growth and like there's like underlying excitement, I don't think you could go wrong. That's one. Number two, make sure that 50K is something that you're willing to lose all of it. And I'm not saying that you plan on losing your 50K, but like just like psychologically write it off in the back of your mind. And then from there, find the best neighborhood and home that you could afford with that 50K too. Like I really urge people to not go penny wise and find the cheapest thing they can. You might think that putting 30 down instead of 50 down de-risks you, but if anything, it increases the risk of all this other stuff that we talked about. I think that's what I would suggest. And then just do it. Last one, probably the most important. Just do it. Like just go try it out, see what happens. And you might love it and you might hate it. Regardless, know that you're learning a lot. And if you love it, you're going to do a lot more of it. And so this first deal is not really going to matter in hindsight. Yes. What about you?
I didn't think you were going to turn around on me. So man, if you have 50K that you worked so hard for, it took a while not to invest all of it, invest 30 of it, right? Because it might go really wrong. The advantage of real estate, at least, it's probably not going to go to 0-0. You might lose a lot of it, but you still have a hard asset you can liquidate for, something. I would honestly, for the first couple of deals, co-invest with a local operator who's been doing it for a while, even if I'm giving up part of the upside, even if I have to pay management, because I will learn from that person. Something like, hey, I'll invest with you, but like I want to do a monthly call and learn from you from this and that, because it's like having a mentor, right? Like it's going to shorten so much that I think it's the investment, right? And from personal experience, you put all your eggs in one basket and something goes wrong. Now the 50K, it really is painful, right? It's really painful. Instead of trying to diversify a little bit, I would try to start smaller, learn, shorten my learning curve as much as possible, and then do more. But definitely get my feet wet and definitely go start the learning experience, because there's nothing more than you put your money to use and you're like, oh my God, it's going wrong. And then you have to learn, right? That negative reinforcement is exponentially stronger than just everything's pretty and everything's beautiful and everything's whatever. We got to do a lot more of these, all right?
Yeah, that's good. That's good.